What are the best ways to earn 10% annual returns getting paid out quarterly? Well, I'm going to talk about that in today's video. Now, there's a number of ways which you can earn a handsome rate of return, and they range in risk, they range in their uniqueness. Everything's got pros and cons. So let's uncover four different ways in which you can earn double digit returns. So the first one is the old tried and true, what we've always been told since the day we were a kid is invest in the stock market. Well, so the pitch there is just buy dividend stocks, hold for the long term, and earn 8 to 10% a year. So the pros of it, it's liquid. You can easily get your money in and out. Now, the cons of that, in order to get 8 to 10% a year, you're betting on growth and dividends because dividends alone aren't going to get you there. And the result of that is that one year you might be up 12%, the next year might be down 18%. There's swings each direction. So it's super challenging to achieve that kind of return, getting paid out quarterly on a consistent basis. The next one you hear a lot of, we'll talk about today, is the second one is rental properties. Just buy rental properties, buy them, earn 10% cash on cash returns, let your tenants pay down that mortgage. It's absolutely achievable. The pros of it, you got a tangible asset. You have a hard, real asset. And that's been terrific in the current environment. You got tax advantages. You got potential appreciation. I say potential because it depends on how that tenant takes care of that property. Because you may find yourself some number of years from now when the tenant vacates and you think you've got some appreciation, and what you've got is a large rehab bill coming due to get that thing back into shape. And that obviously is one of the cons, right? You've got tenants, you got toilets, you got termites, you got turnover. Even with property managers, you're tied to some level of the headaches associated with that. Surprise expenses certainly could have regional or local real estate swings. The third one, private equity or venture capital. Get in early, right? Watch that unicorn, bet on the unicorn, get 10 times your money over a period of time. You can get big, huge upside potential, ultimately life changing potential in those dollars and cents if you get the winner. The con is obviously it's illiquid, it's highly speculative. You got to have a holding period that typically is multiple years out. And sometimes those things just don't return. Fourth one, debt funds. You can lend, you can co lend, earn steady interest on real estate. Loans backed by real estate, that is, target annualized returns of 8 to 12%. Certainly in the double digit range is easily achievable. The pro is you get predictable, steady cash flow. It's backed by collateral, short to midterm loans. So anywhere from 6 months to 2 years, you can be in and out of these things. They're far less volatile. Now, the cons are 6 to 2 years, 6 months to 2 years. You get your money tied up for a period of time, not super extended, but a period of time. They're illiquid, meaning that when your money is into a loan, that loan typically has got to pay off in order for you to get that cash return back. And it does require some trust. If you're going to go in and co-lend with somebody, you got to vet that person, and it requires trusting that person. So I've given you four different ways in order to earn double digit returns. You've got the stock market, you've got buying rental properties directly, you've got private equity, and then you've got the lending model or co-lending model. That's what we do here at Little Guy Loans. If you have interest in learning more about what we do specifically as it relates to co-lending, I'll drop a link in the description here. And so you can watch the video there where I can explain it in more detail.